As of mid-2026, the European Space Agency's Space Debris Office tracks more than 54,000 objects larger than 10 centimeters moving through Earth orbit at speeds up to 17,500 miles an hour, with an estimated 1.2 million more objects between 1 and 10 centimeters that no radar on the ground can reliably follow. Behind all of it, every satellite carrying every phone call, every GPS signal, every bank transaction timestamp, stands a global space insurance market whose maximum theoretical capacity for a single catastrophic year is around $1.4 billion combined across launch and in-orbit risk. That is the entire cushion the world has built. One collision in the wrong place is enough to test whether it holds. The public conversation about orbital debris is almost entirely physical. How many objects are up there? Whether a Kessler syndrome cascade is coming? How fast satellites are multiplying? The financial architecture sitting underneath that conversation gets almost no attention at all. And the data shows the mainstream framing has the risk backwards. The real question was never whether a satellite gets destroyed. Satellites get destroyed on a schedule now. In January 2026, a Spanish military satellite insured for roughly $400 million was rendered a total loss by a fragment smaller than a pea. The fault line that actually matters is what happens to the small, concentrated pool of underwriters who are supposed to absorb losses like that one, and what happens to everyone downstream when they eventually can't. In 1978, NASA scientist Donald Kessler proposed that a sufficiently crowded low Earth orbit would become self-polluting, each collision generating debris that raises the odds of the next collision until entire altitude bands became unusable. For 3 decades, that was a theoretical exercise. Then, on February 10, 2009, an active Iridium communications satellite and a defunct Russian Kosmos satellite collided at a closing speed of roughly 11.7 kilometers per second. The impact created more than 2,300 trackable fragments in a matter of seconds, and proved the mechanism was real, not hypothetical. Space insurance is almost as old as the satellite industry itself, and it has always been a small, specialist market. A handful of underwriting syndicates, most of them clustered at Lloyd's of London, pooling capacity to cover assets that can cost hundreds of millions of dollars each. Today, more than 34 specialist space risk syndicates operate at Lloyd's alone. That structure worked reasonably well when there were a few hundred high-value satellites in predictable orbits. It was never built for a low Earth orbit environment, carrying tens of thousands of tracked objects and growing by the thousands every year, driven overwhelmingly by the rise of mega-constellations since 2019. By 2026, the European Space Agency's own tracking model puts the population of orbital debris larger than 10 centimeters at roughly 54,000 objects, including around 9,300 active payloads mixed directly into that debris field. The growth curve has not leveled off. It has accelerated, and the underwriting market meant to price the risk of all of it has not grown anywhere near as fast. The numbers from the market itself tell the story plainly. Aon's own space insurance market report for the first quarter of 2026 puts the maximum theoretical global capacity at roughly $709 million for launch risk and $669 million for in-orbit risk. The maximum working capacity, the amount underwriters will actually deploy on any given risk, is lower still, around $425 million and $375 million respectively. The entire global space insurance premium pool sits at only about $4.4 billion in 2026, against a global space economy valued at $626 billion and rising toward $1 trillion by the mid-2030s. That gap already broke the market once. Industry analysis of the 2023 loss year found underwriters collected roughly $557 million in premium and paid out nearly $995 million in claims, a loss ratio near 180%, driven by a handful of named satellite failures. Then, in January 2026, Spain's SpainSat NG II military communications satellite was struck by a millimeter-scale space particle while maneuvering toward its final orbit, and confirmed a total loss 16 days later. The satellite was insured for approximately $400 million. A single claim large enough to consume nearly a full year of global underwriting premium on its own. Hisdesat, the satellite's operator, called itself fully insured against this type of incident, and said the loss would not result in economic damage to the company. Most operators have already made their own calculation about this fragility. SpaceX does not insure its Starlink constellation at all. It self-insures, accepting individual satellite losses as an operating cost rather than paying premium into a market it considers too thin and too expensive. Fewer than 1% of active low Earth orbit satellites carry any in-orbit insurance coverage today. The formal market exists almost entirely to cover a shrinking slice of high-value government and geostationary assets. While the insurance trade press itself has started describing a genuine collision cascade scenario as a threat capable of producing, in its words, liability claims with no clear precedent in existing treaty law, no established fault framework, and potentially no solvent defendant. None of this requires a cinematic cascade to matter. The most likely path over the next 12 to 24 months is simply more of what is already happening. Premiums keep hardening, underwriting capacity keeps concentrating into fewer specialist syndicates, and self-insurance becomes the default for anyone operating a large constellation, while smaller and government operators absorb steadily rising costs for coverage that is shrinking in scope. The more consequential scenario is a single large loss event, not a cascade, just one bad collision in a congested commercial shell. Large enough to consume a full year of global capacity in one claim, the way SpainSat NG II nearly did on its own. That is the point at which underwriters have historically not softened terms gradually. They have pulled coverage outright, on short notice. It has happened before, just not in orbit. When war risk insurers canceled aviation coverage within days of September 11, 2001, airlines were left without hull and liability protection until the Federal Aviation Administration stepped in with an emergency backstop. Congress eventually created a permanent federal reinsurance program because the private market could not reconstitute on its own. Nobody has built that backstop for orbit. If a genuine Kessler-scale cascade did occur in one of the most congested shells, the effect would not stay contained to the space industry. Satellite services already underpin a $626 billion and growing global space economy, woven into telecommunications, positioning, weather, and financial transaction timing infrastructure most people never think about. GPS-enabled services alone are estimated to have generated over $1.4 trillion in downstream U.S. economic value since the 1980s. A collapse in the willingness of a market this small to keep underwriting that infrastructure would not just be a space story. It would be a capital market story, playing out in an industry that has never had to test whether its safety net actually works. The insurance industry has already run this experiment once, in a different sector, and it took an act of Congress to keep it from spreading. Nobody has built the equivalent for orbit yet. The question is not really whether the next satellite gets destroyed. That keeps happening on schedule. It's whether, when the claim is finally too large for the market to absorb, anyone on the ground has decided who pays.